Good morning, folks. It's April 22nd. It's about 6:30 a.m. Monday morning, and markets look like they're going to go up. So I'm going to look at a couple of our trades and then also look at a new trade. The first one we're looking at is Google, and Google on Friday really crept up, and it was our Iron Condor was doing well. It had about a $6,000 profit, but then we snoozed a little bit, and Google just went up. So let's see what the position is. Then, of course, I changed it. I closed out my 720, 700 and opened new ones at 760 and 740. You can see we are fairly delta neutral. We picked up about 3,300 in profits. And of course, but now our bear call was hurting because Google made a sudden move up, and it was too soon to, it happened very quickly and we couldn't catch it. But let's take a look at what the Google chart looks like, and let's see here. Anyway, so Google's moving up. So what we have now, what we need to do is protect the bear call side. So let's go take a look at what kind of adjustments would be good. So we're dealing with the May series, and if you wanted to adjust it on a temporary basis, you could perhaps come to the weeklies and see what you can do here. So if you look at the weeklies, if we went in for, let's say, the 790, so this will be an in the money option. It's got only 4 days, so you're going to see some theta decay here, but let's just see how an in the money call would affect our position. So if we bought 10, obviously our delta is going to go way higher. So we we don't want that kind of a delta. So perhaps 3 contracts. Let's see what it does. It gives you a 200 delta. We still have a positive theta, so we're still going to be gaining from time decay. And what we would pay here is about $15 for this option, and then so we would pay 4,500. So let's say if we looked at, let's take this off first. If we looked at this, we on my position at least, I have an 18,000 max profit. So out of the 18,000 max profit, if we were willing to give up 1,500, that I'm assuming that this is going to expire worthless, which is probably very unrealistic. So then what we do is we can buy 3 of these contracts, and once we put those in, I'll have to change this to 2 expirations, and then you can see, we've basically protected. Our white line is going flat all over, so then we've got room till about 835 on the call side. So this is not a bad adjustment given my position. My position is obviously a little big, but that's how it was from the beginning itself. And if you just put the 3 contracts, we're going to give it a 200 delta, which is a decent delta, I think. If Google's going to continue to move up, then this is what I would do, at least make the line flat. But what it does is it only gives you protection for the next 4 days, because this option that we put here is going to expire in 4 days. But it's an in the money call. You're going to pay less for it, and it gives you the required adjustment at least for the next 4 days. So I'm okay with that. We're still theta positive, and we are vega negative. So if Google continues to go up, the volatility also will be coming down. So that's as far as the Google trading. I'm going to put adjustment. I like it. And let's go take a look at what next one is. Goldman Sachs, you can see it's been down, and of course the markets were also down, and Goldman Sachs for some reason had reported good earnings, but it hasn't performed yet. But we can see that on our short call, we still have about $450 there. So I'm going to leave Goldman Sachs as is for now. If Goldman Sachs continues to go down, then what we would do is pocket more, get more profit out of this 400, perhaps another 250 or so, and then close this trade, and we have about 1,000, and then perhaps turn it into a bear call by putting in a short call at the 155. So that's as far as Goldman Sachs is concerned. IBM is the only one that is in serious trouble, because IBM generally reports good earnings, and I'd put in a bull call spread, thinking that that would continue. But obviously, markets have a way of proving you wrong, and that's exactly what happened with IBM. And IBM actually went down almost $15, I believe. On Friday after they reported after they missed their earnings. It's very rare that IBM misses, but this happens to be one of the times that they missed. So now IBM is it's basically a gone case, because you can see this option is going for 8 cents. It's got a delta of position delta of 18. So the individual delta of this option is 1 or 1.8. So this is a gone case. But what we want to do, and in general, when you have trades like this, it's a losing trade. You just have to close it out and move on. But what I don't want to do is just close it out and move on. Now, last week we had two big trades. The gold trade, we turned it into a strangle, a long strangle, and gold made about $7,000 in profit. Google made about 3,300. Google had more, but we couldn't react in time. But so last week was a good week. So if you looked at it from that angle, you had two very good trades, and we could have closed out Google at 6,000. So between those two trades, we would have had 13,000, and therefore, if you take a loss of about 2,200 on the IBM, it's fine. You're going to see losers like that. But this trade is a gone case, because you can see the delta is 1. So it has a 1% chance that IBM is going to go to 220. But what we can do in this situation is, this option is anyway gone, but instead of just closing it out, it's, you're going to get only $85 for this. Instead of closing it out, you can use this call as a anchor, because you have this 10 long options. Therefore, if you sell, let's say, for example, you sold 10 calls at the 210 level, you already have this as an anchor position. So, your risk on the, it becomes a spread, and therefore, what you can do is slowly chip away at your loss. So which means you chip away at your loss, you can reduce your losses. So for example, what I mean is, let's go to IBM and take a look at the options there. So this is our long call, and if we wanted to add a short call, let's say we went to the May series, and on the May series, let's see what the option prices are. It's not going to be a whole lot. Yeah, because it's 190, the 195 is getting you about 90 cents, not a whole lot. Let's go to the next one. Let's go to the May, which has 18 days. And, in the 18 days, you can chip away, you can chip away, get 40 cents. So you'll chip away with about $400 here. Rather than do all that, I would say, let's come to the May monthly series itself and see what that looks like. And again, so IBM, a lot of volatility has come down. So let's just go to our June series where we have our long call. So we've got a long call right here at the 220. The 210 is going for about 25 cents, not a whole lot. The 205 is getting you about 67 cents. So that's not bad. So if we sold 10 of these, then we would get 67 cents. So which means $670. So at least you could have, you can reduce your cost basis by $670. If you wanted to do it a little more, you could come and sell the 200, and that would give you about $1.40. And but again, by selling this, you are going to increase your margin. And at this point, it just doesn't, seem worth it to do that. But I'm just saying, if this call, if the 220 call had a good shot, had a decent shot, say like a 15 delta, then we could have tried that. But unfortunately, the 220 call, as you can see, has a 2 delta. So it's a gone case. So basically. So I'm just going to close it out. If it had a better chance, and if we had some more premiums at the 210 level, we could have tried something like this. But at this point, just this particular trade, you're just going to have to take it as a loser and move on. And we had a couple of big trades last week, so this is part of the game, and we can just move on and take it from there. Now, what I'm looking, I don't know if any of you put the Chipotle trade last week, I mean, on Friday, because this was, again, it had opened around 345, maybe 348, and then just like Google, it suddenly shot up and it went up all the way to 366. And I had pointed it out on Friday's email, but I did not take the trade. And again, we were looking at different things, and so I did not take the trade. I hope some of you took the trade, because this would have been a fantastic long call or a bull call spread. Chipotle went up by about $35. So right now, I don't, it's gone up too much, so I would wait for a pullback. But in general, over the next 2 months, Chipotle is going to be looking bullish because it's come out with a good report, and the effects of that is going to carry through until its next report 3 months away. But of course, all of that is dependent on how the overall market is doing. For today, I wanted to look at LinkedIn, but again, all these stocks are reporting earnings, and that's the problem. They tend to disrupt your cycle. So the earnings is on 5-2. So if I wanted to play LinkedIn, I want to play it on the bullish side, because LinkedIn has come on. Let's look at LinkedIn chart here. And it went up to 186, and then over the last few days, when the markets were a little choppy, it's come down to 174. So I expect LinkedIn to go up again. So I think if you wanted to avoid the earnings cycle, let's see. So this is 59%. So this is the series that's going to be impacted by the earnings. You can see that its volatility is about 59%. So let's go to the June series, and I have something here. I'm going to take it off. If you go to the June series, and you could do two things. You can sell a bull put, and you can also buy a bull call. I think I'm going to sell a bull put, because buying these directional spreads, basically you're betting on the direction. So rather than do that, I would much rather sell a bull put, let's say at the 150 level. It has an 18 delta. 150 to 145 is 89 cents. So you're getting almost a 18% credit on this. It's got 60 days, so obviously we don't want to hold it all the way down to down to expiry. We'll probably want to hold it for about 3 weeks or so, and capitalize perhaps 40% or 50% of this. And if we get a bull move, then obviously our profits are going to come in quicker. So you could do something like this. You could do something like a $10 spread, and that would give you approximately a 16% return. I think this is good. Selling at the 150, 140 level, the 150 is at a delta of 18. I do expect LinkedIn to go up, so this bull put should make a quicker profit then. So this is a good trade. So I'm going to put in this trade for today and see how it goes. So we're going to keep the Goldman Sachs. I'm going to add the weekly to the Google. I'll close the IBM, and if anybody is on the Chipotle, good for you. You did a great trade. I'm going to wait for a slight pullback before we want to get into Chipotle again, because it just moved up $35 on Friday, so you don't want to take a bullish position at this point, but wait for a slight pullback and then go in for that trade. So this is the trade for today, LinkedIn, and hope you guys have a great week, and we'll talk to you soon. Thanks. Bye-bye.